Thanks for joining me in this discussion about cashing out at full value. My name is Mike Gendron. I'm a partner with CFO Insight. And we're going to talk about value today, corporate value. And my target is middle market companies to, let's say, acquaint you with what a buyer will be looking for. But a little background information first. We're going to talk about four things today, just four things. PE ratios, that is, as a buyer, seller, what is your company worth as a multiple of earnings? Future cash flows, that's the only thing that matters to a potential buyer. Third would be, what increased earnings mean to you in capital gain? And fourth, I'd like to talk about how you manage a business strategically. Strategically. Your business is probably one of the largest individual components of your personal wealth. Do you look at it that way? So let's start. PE ratios. Quite often we hear about a PE ratio as a multiple of EBITDA, that's earnings before interest, taxes, depreciation, and amortization. You'll see in the chart that we have here, there are three lines, a 3 multiple, a 5 multiple, and a 7 multiple. Well, when you hear multiples, earnings multiples, you're really talking about averages. And there's really a range based on the quality of the company, the performance of the company, the potential future cash flow value of a company. Things that might affect the range. A 3 multiple in a certain industry might have organizational problems, might have a short product pipeline, may not be well managed, slower growth rates in general. A 7 multiple might be a well-organized, well-staffed organization that has a deep product pipeline, business processes that work, and a facility that's impeccable. Those are things that are important in value. They will affect your PE ratio. Market position, market share, all of those things are elements that affect the multiple. So as an introduction to what we're going to talk about in the next few sessions, I'd like you to think of that target multiple and raise it, because you're going to make your business run better. You're going to make your business run better. Let's talk about future cash flows. As a buyer, the only thing that really matters to me is future cash flow. Historical earnings, that's a great benchmark, but that doesn't ensure my future. I'm looking for probability of a fairly certain cash flow as I move forward after I buy your business. So now I've got a chart, ABC, 3 different lines in it, 3 different lines. You'll see the A line starts out with the least negative cash flow. That's the smallest purchase price of the 3 items there. You'll see that the line dips because I have to add cash to the business. I may have to change the organization. I may have to hire new people. I may have to train people. I may have to put in new business processes. Each of those is an element of cost, and actually what it does is shorten the purchase price. When you look at line B, it's a little bit more expensive. The negative cash flow is higher. Why is that? Well, it's more valuable. You'll see that I turn positive cash flow much quicker than line A. And of course, you get to line C, most expensive. That means the seller gets the largest purchase price, and it also converts the most favorable positive cash flow on a cumulative basis of any of the 3. Well, when we position our company for sale, when we prep for sale, what we're doing is moving that cash flow likelihood, the positive cash flow likelihood, forward in the timeline. So future cash flow is the real key, and how you prepare your company for sale will change the selling price of your company. It's pretty simple, pretty straightforward. The next thing is that I wanted to talk about is increased earnings. Many middle market companies manage from year to year looking for a certain percentage increase in earnings, maybe 5%, 7%. And what I'd like to do is bring up a topic that really is tremendous value to an individual investor. You are in charge of your business. And if you think strategically, and do things like change your organization or new product lines or new product platforms, maybe new geographies, as you make those investments, those strategic investments, your cash flows will likely increase. In fact, your profits will probably increase. Now, to do that over a 1 or 2 year period is sometimes difficult. That's why I'm encouraging people to think of your business strategically. Think of your business strategically. So, for example, if you have to add a new factory, well, that's not something you do looking out 1 year. You look out 3, 5, 10 years. But a new factory could change your cost of sales structure to a point where you improve your profitability through increased volume, increased efficiencies. Perhaps you buy new equipment to improve efficiencies. Well, as you think about your business strategically, understand that $1 million of increased earnings today gives you a multiple of that in selling price. Not only that, not only are your earnings higher, but you're probably a more desirable company compared to competitive operations in the same industry, same area. Think about it. Think about it. So $1 million of increased earnings today could equal $5 million or $7 million increased selling price in 2 or 3 years. Not a bad trade. So when you're making your decisions about how to run the business, think long-term, think multiples. Now, the last point I want to talk about is your business as an element of your personal wealth. I want you to manage your business strategically. Quite often, individual investors have investment advisors who talk about interest rates, the federal tax rates, international complexities in investment, and quite often you bring in the professionals to help you refocus on what your objectives are and how you're going to get there. How often do you do the same with your business? How often do you do that with your business? Think strategically. Well, I want you to think of your business as the largest single element of your wealth portfolio and think of it strategically, not year to year, but strategically. So today in our introduction that we call Cashing Out at Full Value, we've talked about 4 items. We've talked about PE ratios that are averages, and you as the business owner have the opportunity to raise your multiple through better management. We've talked about future cash flows as the key to selling price. So if you stage your company, you prepare your company so that a future buyer will have faster cash flows, higher cash flows, your selling price will be higher. We've talked about the earnings multiple, and when you think day-to-day activity, think of what earnings multiples will do to your wealth position. $1 million of earnings today might equal $5 to $7 million of capital gain in the near future. And lastly, think of your business as a strategic investment and manage it so. Now, one other point. Preparing your company for sale does not necessarily mean you're going to sell it. It will be better managed, and you'll have options. It's a way to create options. Quick summary for today. In the future, we're going to be talking about strategic planning, and that is your business. And we're going to talk about the elements of your business: people, process, plant and assets, product, and market. Thanks for joining me. Hope to see you soon.